Friends, cast your minds back to the late 1990s. A new dawn was breaking, one powered not by factories or oil fields, but by something intangible: information. The internet, once a niche tool for academics and engineers, was exploding into the mainstream, promising a revolution. Suddenly, everyone could connect, learn, and even shop online. This wasn't just a technological shift, it was a societal earthquake, and savvy investors saw not just a new utility, but a gold rush, a chance to get rich beyond their wildest dreams. The air was thick with optimism. Overnight, new companies sprang up, each with a .com suffix, promising to disrupt every industry imaginable. From pet supplies to grocery delivery, from online travel to digital advertising, the possibilities seemed endless. Venture capitalists, always on the hunt for the next big thing, poured billions into these nascent startups. Garages and college dorms became the epicenters of innovation, brimming with young entrepreneurs convinced they were building the future. They weren't just selling products, they were selling a vision, a brave new world where everything would be done online. Soon, the excitement spilled onto Wall Street. Initial public offerings, or IPOs, for these .com companies became the hottest tickets in town. Companies with little revenue, let alone profit, were hitting the stock market with astonishing valuations. Investors, fearing they'd miss out on the next Microsoft or Amazon, clamored to buy shares, often driving prices up by hundreds of % on the very first day of trading. It was a self-reinforcing cycle of optimism. The higher the stocks went, the more people wanted to join the party, fueling an ever-expanding frenzy. Economists and seasoned investors began to warn of irrational exuberance, but their voices were drowned out by the roar of the market. The old rules of valuation, like price-to-earnings ratios, seemed utterly irrelevant. Companies were valued not on what they earned today, but on their potential to dominate a future digital landscape. Growth, user acquisition, and website traffic became the new metrics, even if those users weren't paying a dime. Money wasn't just being invested, it was being thrown at anything with a .com in its name, regardless of its underlying business model. The NASDAQ Composite Index, heavily weighted with technology stocks, became the ultimate barometer of this new economy. Throughout the late 90s, it soared to dizzying heights, making millionaires out of ordinary people and turning tech founders into overnight titans. The media fanned the flames, with every financial news outlet breathlessly reporting on the latest surge, the newest tech darling, and the staggering fortunes being made. It felt like a perpetual motion machine, defying gravity and common sense, convincing everyone that this time it truly was different. At its core, this was the greater fool theory in action. People weren't buying stocks because they believed in the company's long-term profitability. They were buying them because they believed someone else, a greater fool, would pay even more for them tomorrow. It was a game of musical chairs, where everyone hoped to be sitting down when the music stopped. Everyone from seasoned hedge fund managers to individual retail investors pouring their life savings into questionable ventures, all caught in the contagious fervor of getting rich quick. Yet, beneath the surface, cracks were beginning to show. Many .com companies were burning through cash at an alarming rate, spending heavily on marketing and infrastructure without generating substantial revenue. Some even offered free services, hoping to monetize later, a strategy that quickly became unsustainable. Analyst reports buried beneath the hype highlighted these fundamental weaknesses, but few listened. The party was too good, the music too loud, and the fear of missing out too powerful to heed any warnings of an impending crash. The signs were there for those who looked. Then came March 10, 2000. The NASDAQ Composite hit its all-time high of 5,048.62. What followed was not a sudden explosion, but a slow, agonizing unraveling. Investors, perhaps feeling the first tremors of doubt, began to take profits. The selling started gradually, then accelerated. Companies that had once soared now saw their stock prices dip, then plummet. The greater fools began to disappear, and the music, which had played so loudly for so long, finally started to fade, leaving many without a chair. As stock prices fell, so did the ability of these cash-hungry .coms to raise more capital. Venture capitalists tightened their belts, and IPOs dried up. Without new funding, many companies, especially those with no clear path to profitability, simply ran out of money. One by one, they filed for bankruptcy, shutting their doors, laying off thousands of employees, and leaving investors with worthless stock certificates.
The dream of a digital utopia turned into a nightmare of pink slips and empty office buildings, a stark reminder of unchecked speculation. The numbers were staggering. Between March 2000 and October 2002, the NASDAQ lost 78% of its value. Trillions of dollars in market capitalization evaporated globally. Major players like Amazon saw their stock drop 90% from their peak. Cisco Systems, once the most valuable company in the world, lost over 80%. Retirement accounts were decimated, college funds evaporated, and countless individual investors watched their paper fortunes vanish, learning a painful lesson about market volatility and risk.
Beyond the financial markets, the impact rippled through the economy. Cities like San Francisco and Seattle, once booming with tech startups, experienced sharp downturns. Unemployment rates rose, and the construction boom that had fueled new office spaces and housing came to an abrupt halt. The optimistic, free-spending culture of the dot-com era gave way to austerity and uncertainty. This wasn't just a correction, it was a painful recalibration of expectations, forcing a cold, hard look at the true value of innovation versus pure speculation. While every bubble has its unique characteristics, the dot-com crash shared fundamental similarities with historical financial manias, from tulip mania to the South Sea bubble. It was driven by a revolutionary new technology, combined with widespread public enthusiasm, cheap money, and a collective belief that this time it's different. The promise of instant wealth blinded many to the underlying economic realities, proving once again that human nature, when confronted with the prospect of easy riches, often succumbs to the same patterns of irrationality. The venture capital industry, which had fueled much of the initial boom, learned harsh lessons. The focus shifted from rapid growth at any cost to sustainable business models and clear paths to profitability. Due diligence became paramount, and the expectation of quick exits and sky-high valuations gave way to more sober, long-term investment strategies. Many firms that survived reinvented themselves, understanding that even revolutionary ideas need sound financial footing to truly thrive and deliver value beyond just hype. But the story doesn't end with the crash. From the ashes of the dot-com bust emerged a new, more resilient internet. Companies that survived, or new ones that learned from the mistakes of their predecessors, focused on robust technology and tangible user value. This period, often called Web 2.0, saw the rise of social media, user-generated content, and more sophisticated e-commerce platforms. The shakeout purged the weak, leaving a stronger foundation for the internet we know today, proving that innovation can endure even great financial setbacks. Some of the companies that were considered dot-coms during the bubble not only survived but thrived, becoming the tech giants of today. Amazon, which saw its stock plummet, focused on customer service and expanding its offerings. eBay continued its dominance in online auctions. Google, which went public after the crash, benefited from a more mature market and a superior business model. These companies understood that technology was just a tool. Real value came from solving real problems efficiently and profitably, building strong foundations, not just grand visions. One often overlooked legacy of the dot-com bubble was the massive investment in internet infrastructure. During the boom, vast sums were spent on laying fiber optic cables, building data centers, and developing networking technologies. While much of this capacity was underutilized immediately after the crash, it laid the groundwork for the rapid expansion of broadband internet and the subsequent explosion of online services. The physical backbone of the internet was built, ready for the next wave of digital innovation, even if many of those who built it lost fortunes. The dot-com bubble stands as a powerful testament to the enduring principles of investor psychology. Fear and greed, the twin engines of market behavior, were on full display. The herd mentality, the desire to participate in a seemingly effortless path to wealth, proved irresistible for many. It reinforced the idea that market bubbles are not just about economics, but about human nature itself, and our inherent tendency to get carried away by optimism, especially when coupled with transformative technological change and the siren song of quick riches. Following the crash, there was a renewed focus on market regulation and corporate governance. The Sarbanes-Oxley Act, passed in 2002, aimed to improve corporate accountability and transparency, partly in response to the accounting scandals that emerged around this time, like Enron and WorldCom, which weren't direct dot-com failures, but contributed to the general climate of mistrust.
The lessons learned about inflated revenues and misleading financial reporting helped to shape stricter oversight, though the effectiveness of these measures remains a perennial debate. The dot-com bust also reshaped the culture of Silicon Valley. The initial ethos of move fast and break things with little regard for profitability was tempered. While innovation remained central, a greater emphasis was placed on sustainable business models, lean operations, and a clearer path to monetization. The era of lavish spending on absurd perks and brand building at any cost came to an end. It was a maturing moment for the industry, forcing a more pragmatic approach to building real, lasting businesses in the digital realm. In recent years, many have drawn parallels between the dot-com bubble and the rise and fall of cryptocurrencies and NFTs. The promise of a new, decentralized financial system, coupled with unprecedented speculative gains, echoed the internet frenzy. While distinct technologies, the psychological drivers, fear of missing out, belief in a transformative but poorly understood technology, and valuation detached from traditional assets remain strikingly similar, reminding us that history, while not repeating exactly, often rhymes in its patterns of human behavior and financial speculation.
The dot-com bubble serves as a potent example of how financial speculation often accompanies technological revolutions. From canals and railroads to radio and artificial intelligence, each wave of transformative innovation tends to ignite a period of irrational exuberance. People correctly identify the revolutionary potential, but mistakenly extrapolate short-term gains into an endless upward trajectory, overlooking the critical, often messy process of real-world implementation and the eventual shakeout of unsustainable ventures. It's a recurring pattern throughout economic history. Some argue that the Federal Reserve's monetary policy played a role in inflating the bubble. Low interest rates in the late 90s, intended to stimulate economic growth, made it easier for companies to borrow and for investors to take on more risk. When the Fed began raising rates in 1999 and 2000, it acted as a pin, slowly deflating the balloon by making speculative investments less attractive and increasing the cost of capital for cash-burning companies, adding another layer of complexity to the crash. Despite the massive financial destruction, the underlying innovation of the internet endured. The bubble wasn't a repudiation of the technology itself, but a harsh correction of its economic valuation. The internet truly did change the world, just not every dot-com company was destined to be a winner. The crash taught entrepreneurs and investors that even the most revolutionary ideas need solid business fundamentals, a clear path to revenue, and a sustainable model to transform potential into enduring value and avoid becoming just another historical footnote. Today, it's almost impossible to imagine life without the internet. It underpins global commerce, communication, and entertainment. The dot-com bubble, for all its chaos and financial pain, was a crucible that forged the modern digital landscape. It separated the truly transformative ideas from the merely hyped, allowing the internet to mature and integrate into the very fabric of our lives. It was a painful, expensive lesson, but one that ultimately paved the way for a more robust and essential digital future than anyone could have imagined at the peak. So, what's the ultimate lesson from the dot-com era? It's a timeless one, echoing through every financial panic and speculative mania. While innovation can truly transform the world, it often comes with a hefty price tag of irrational exuberance and speculative excess. The promise of untold riches can blind even the savviest investors to fundamental economic truths. The internet didn't break. The market simply corrected its unsustainable belief in growth without profit. This story, friends, is a powerful reminder that while technology evolves, human nature in the face of immense wealth rarely does.